I got an email question overnight from Paul. Question talks about, why is the market hitting new all-time highs? What's driving this market to new all-time highs? The answer, in short, is earnings. The answer, in short, is earnings and positive momentum around the economy as a whole. Because at the end of the day, we've talked about this in the past on this many times, but the market will be, a stock will be a reflection of its current cash flows and its projected future cash flows discounted to today. So if you have a company that's expected to make $1 this year and $1.10 next year and $1.20 the year after, you use a discount rate, you bring it back to today, and that's the valuation of your company. Obviously, there's other ways to do it, but largely, this is how most people evaluate. And what do they use for that? They use a multiple of earnings. And what is the multiple? The base in there is earnings. Earnings are the most important thing, because if we're buying something, and if you and I were going out and buying a manufacturing company or a plumbing company or whatever, we'd want to know, is it profitable, right? Is the company profitable? Same thing we do when we buy stocks in your portfolio. Is it profitable? And then how much profit? How much is it growing? Is it in a sector that we expect to see more growth? How's management? But the first variable is earnings. So there's maybe a misconception around how earnings have done. So I'm going to show you a chart here. This is earnings since, I guess, the beginning of 2022. This is the S&P 500. Next, so the forward earnings per share. It's the highest it's ever been by a long stretch. No wonder our market is hitting all-time highs. Right now, the S&P, the TSX, the NASDAQ, the Dow, they are all at or near all-time highs. And this is why, in a nutshell, we are seeing the earnings of all of those companies as a whole, as an aggregate, make new all-time highs. Now, why is that happening is a separate question. I think there's more confidence in the market. People are spending a little bit more. Interest rates are coming down. There's technology is bringing savings to some companies. There's a whole bunch of reasons why that's happening, but largely they were beat up here, right? There was a period of time where we weren't expecting corporations to be profitable, and now, boom, we're recovering from that. If you extend this chart further, I promise you, it's a reflection of what the S&P 500 looks like as a whole. It's the biggest correlation that exists.
I love this question, but the problem is it's going to beg the next question, which is, should, everyone always says, buy low, sell high. So, if everything's always at an all-time high, what do we do? I get that question all the time.
This is another chart here that talks about U.S. corporate profits. And this is IVA is the inventory and CCA is the credit allowance or something like that. But anyways, it's the same chart. It goes a little further back, and I will answer your question, Tania. This is corporate profits 3 years. This is 20 plus years. You're seeing that chart, right? You're seeing just the growth and what happens to stocks. They reflect that. But your question was, should we not, can you remind me your question?
Well, seeing as we should buy low and sell high, at least that's what everyone feels they've always been told. How do we go about buying when we're always hitting all-time highs?
The markets are at all-time highs. Yeah. Okay. Mm-hmm. I got a chart for you on this, actually.
Because I feel like that would be the follow-up question to this, first of all, what's driving all-time highs, and what do we do now?
Before I do that, I'm going to ask everyone who's watching to think about this question for a sec. If you had the choice, everyone who's watching, you're going to play this game at home with me. And anyone who's listened to me in the past, they know the answer already. But I'm going to ask you, if you had the choice of investing, pick any random day or investing every single day when the market hits a new all-time high, or any other day. Okay, so either you're investing when the market hits an all-time high or any other day, which one would you choose to invest in? Which one would have the higher forward returns after that in the future? Well, I think you know the answer now because I've let it into you, but the market actually performs better when you invest at all-time highs. On the right here, there's a chart from 1988 to December 31st. If you invest on any day, what your returns look a year out, 11%. But if you invest at a new all-time high, 13%. Your 2-year number is 25 versus 28. Your 3-year number, your 5-year number, The punchline is you're better to invest always, constantly, equally. You're always better to spread out your investing if you can than you are to wait for a drop, because we know what happens when you wait for a drop. I talked about it before. The other thing that's really interesting about this chart, Tanya, is that 30% of the time, that all-time high will act as a floor. In other words, the market will never go lower than that. The market will never go lower than that.
30%.
Yeah, a third of the time when you see a market make an all-time high. So if you go, oh, I'm just going to wait for it to come back down. Well, 2/3 of the time that will happen, but a third of the time it's never. That's why people who make, covered call strategies, or anyone who buys a range, trades a range, the day traders out there that are promising guaranteed returns. All you got to do is buy my program. It's $500 and you're going to know how to trade FX and crypto and currency and stocks, and just pay me $50 or $100 or $1,000. And I'm going to give you the secret to day trading. BS. Sorry to be loud and in your face on this, but that you can't do it. And here's why: because this is what they end up doing. They end up thinking that they're just going to trade a range, but in reality, the stock market humbles you, and the stock market doesn't believe in your range, right? And a third of the time is not going to make a newer low than what it just made. If you look at this chart here on the left, 80s, 90s, 2000s, 2010s, 2020s, in pretty much every market cycle, there's a period of time where the market will not come back down. So if you're just waiting and waiting, 6.6% of the time, the S&P 500 closes at an all-time high, right? Or 1 out of 16 days.
Either the companies in the S&P 500 are just going to, continue to grow, or they'll go out of business. So it makes sense that the floor would just keep.
Yeah,
right?
That's a good point. Yeah, absolutely. That's a good point. So anyways, to answer that question about whether or not market's at an all-time high, do I invest today? The answer is yes. Now, there can be a caveat to that, right? If you get $5 million today because you sold a farm or you sold a business and you get all of it today, do I put all of it in the market today? Well, that's a separate question, right? Because now we're talking about market timing risk, right? We're talking about the risk that you happen to invest at a time where the market falls 20, 30% after. We want to protect against that risk. So we do what's called legging in, and we reduce that risk. We invest over time, but we're not going to avoid investing in the market just because the market's at an all-time high. This is proof of why we shouldn't do that. So hopefully I answered that question.